I believe that the easier and more simple your strategy is, the better that you will trade. In all honesty, I see so many overcomplicated technical strategies with, indicators and 150,000 different moving parts. And I used to be the same. I used to have EMAs. I used to have three EMAs. I used to have the RSI. I used to have the MACD, volume, liquidity maps on CoinGlass. You name it. I had it on my chart, and I could not enter into a trade whatsoever. I would need a million things to line up, and they don't usually line up. Or when it would line up, one thing would be missing, so then I wouldn't enter and I would miss a move. So I'd have analysis paralysis, and I'd also have fear of entering. And it wasn't until I cut it all, got rid of every indicator. I don't even use indicators anymore, nothing. I just purely trade price action and support and resistance on the daily and the weekly timeframes, and that is it, like nothing else. So I just want to run through exactly how I trade so you can keep it simple and just effectively manage risk, because realistically, at the end of the day, your strategy has no predictive power on where the market is going to go at all. All your strategy will let you do is manage risk and know when your trade idea is invalid. That's basically all the strategy does. So the more complicated it is, the harder it is to manage risk, the harder it is to enter, and the harder it is to exit. So I just stripped it all back and basically just trade pure support and resistance. And I'll run you through everything I do, my checklist, what I do before I get into a trade, what I'm looking for, how I pre-plan my trades, and where I'm sort of entering, exiting, and then also taking profit. So on the Bitcoin chart, we'll start on the daily here. So I essentially, when I'm looking for my zones, I want to look at the swing highs and the swing lows, like where price has made a major reaction and changed direction, not sort of come up, bounce a little bit, and then come back down, like where it's come down, stopped, and then turned around and gone in the other direction. So the more touches, the better, the stronger the zone. But at the same time, the more it touches a zone, the weaker it gets and whatever else. So an important thing when you are drawing zones, don't draw a line. A line it's too thin, and a zone isn't any this magic. It doesn't have any magic power. All it does is highlight an area of interest where you're looking at potentially entering and exiting into a trade. So first, I'll jump on the charts. I'm looking at the daily. I'm looking at the high time frames, because the zones get respected a lot more on these than what they do on a 5-minute or a 15-minute or an hour. I want to find the major swing highs and the major swing lows where prices bounced and changed direction. You don't have to look too far back. You want to look at current price action, but if the levels align with price action that's further back, great. When you're first looking, you first want to find price. So we'll first find where price is. So price is just here. And now what we want to do is you want to find where price had its last swing high and swing low above and below where price is. So right here, this is what I would call resistance. Now, your zones don't have to be perfect. They just have to cover the wicks and the candles. So price is currently in a resistance zone right now. Looking lower, I can see here price had a reaction here, here, and then here. So I can anchor it off here and draw this support zone down here. You might think, oh, but there's a support zone right here, or there's a support zone right here, but price hasn't respected it. So if you see here price, yes, it might have bounced, but it's pushed through and it's pushed through again. Like you don't want to put support and resistance zones where price is just slashed straight through it, because price will probably do it again. You need to set your zones where institutions and where, sellers and buyers are actually waiting to execute or get out of trades. Once you've found your zones, all I do right now, price is good. I will short right here because price is in a resistance zone, and that's just what I do. I will set an alert above and below price and walk away. That's it. I'll literally walk away. I just won't look at the charts until one of the alerts goes off. What I'll do when, let's just say, for example, right now, price has set an price is targeted this alert, it's gone off. It's now in a resistance zone. Looking back at price action, I'll now look, okay, is price in an uptrend? Is price in a downtrend? Or is price ranging sideways? Right now, price was moving up into an uptrend, but now it's starting to move a little bit sideways. So, okay, great. The short idea is valid. It's at a resistance. It's moving sideways. If price was in an uptrend, I'd be a bit more cautious. I would wait for a break and retest of the zone, or I'd wait for it to come back down to the support here. Trade with the market. Don't trade against it. If it's in an uptrend, look to long. If it's in a downtrend, look to short the market. If it's ranging, just a little bit of both. When price does hit the zone, I usually jump onto the 4-hour chart. I just want to look for some sort of a reaction, a little bit of a consolidation. So if you have a look here, you can see you've got the rejection wicks. Buyers are pushing price up. Buyers are defending the area. Price is consolidating, moving a little bit sideways. Yes, it was over the weekend and there's lower volume, but moving into the next trading day, you can see these candles where buyers are pushing price up, and that's it. And I'll just buy, and I'll leave it. Same as, it's a resistance zone. You can see here, prices come up. You see the sellers defending the area. They've pushed price down. Enter. That's it. That is it. There's no magic formula. There's nothing more that you can do. You just need to keep it basic. You need to keep it simple, because the strategy doesn't have any predicting power. You just need to learn how to manage risk. And the risk structure that I usually run with is a 2-to-1. And if I can't get a 2-to-1, I literally just don't enter. And I will place my trade where I can get a 2-to-1. And if it hits it, it hits. If it doesn't, it doesn't. But the importance is that I'm maintaining the same risk structure, because if I have a 2-to-1 and then I do a 1-to-1 or a 1-to-3 or whatever it might be, then I can't consistently manage my profits and risks, and it's harder to sort of gauge if the strategy is working or not. Also, with the 2-to-1, you need to manage the same amount you need to risk the same amount, on the same trade every single time. And the reason being is because, this is a 2-to-1, right? But then this is also a 2-to-1. So you might have 4 wins here, and then you have 1 loss here. Technically, you have a 70 to 80% win rate, but you're unprofitable because your risk to reward is skewed, and you're risking a different amount on every single trade. And you're like, oh, why am I unprofitable? Because the amount that you're risking is different. Even though the risk to reward is the same, the amount can't change. It'll change. Obviously, you'll have slight variations where sometimes you'll risk a little bit. It won't be perfect every time, but you need to keep it as close as possible. Otherwise, even with a high win rate, you can still be very, very unprofitable. So usually when I go for a trade, I like to put my entries in the middle of the zone, sometimes close to the bottom, and I just keep the stop loss below the previous swing low. So if price broke down here and made a new lower low, then obviously the trend has changed and it's now in a downtrend, and I don't want to over risk and overexpose too much. And then when I set the take profit, I just set it somewhere that is really easy to hit. Something like that. I'm not trying to go, oh, I need to target something, a new all-time high, which it hasn't done it yet. I'm just, trying to trade on hopes and dreams and fear and all that stuff. So I just literally keep it somewhere logical right here. That is, that's a logical spot. Like, that's an easy target. Like, you want somewhere that price will easily hit, and just keep repeating that. Now, the strategy is only 10% of the issue. So trading, the reason why I like to keep the strategy simple is because if you have price, for example, come crashing down right here, and it hits your zone, and you're thinking, oh my God, price is dumping right now, but your strategy is telling you need to buy right here. The psychology of that is going to make you not want to buy, because you're going to think, oh no, it's going to go down, I'm going to lose. So that's why I like to keep the strategy as simple and as basic as possible, because when that is happening, my brain is going to be screaming fear, fear, fear. If you buy now, it's going to dump and you're going to lose money, and avoid loss at all costs. Like, my brain is going to be screaming this at me. So if you've got 100 indicators and it gets to that zone and you're like, oh no, but I need the MACD to cross, and I need this and I need that, so that I can feel safe, so that I can, I'm guaranteed to win this trade because I can't lose, I have to win. And then you won't enter, or you'll enter in a bad position, because by the time everything aligns, you might enter up here. Yes, this one might have worked out a little bit, but if you entered out here and then price pulls back, you're getting a little bit of drawdown, you freak out a little bit, so then you close the trade because you don't want to handle a bigger loss. But in reality, you just need to get rid of the indicators, keep it simple. And trading isn't easy. Trading is hard. And keeping a strategy as simple as possible to make the psychology side easier for you, because all the issues that you have with your psychology when it comes to trading isn't your strategy. It's literally your psychology. So keep it simple. Make it as easy as possible for you to enter and exit into a trade, because your mind's going to be screaming at you, what if you lose? What if you lose? What if you lose? But it's all a part of it. I lose all the time. I probably win 50 to 60% of the time. It's just because I win twice as much when I win and only half as much when I lose. And that's it. That's it. And losses are inevitable. So keep it simple. Make it so it's really easy and mechanical for you to enter, because you're going to have all these emotions and your mind's going to be screaming at you when price is shooting up right now. And then you have to click sell because it's at resistance, because that's what the strategy tells you. So you've got to fight yourself. And then if like I said before, if you've got 100 indicators here, it's just going to make it so much harder. And the reason why I use the daily and the weekly is because these levels get respected a lot more. Like, for example, here, like this is back in December. Like, how many times has price returned to this level? Like 1, 2, 3, 4, 5, 6, 7 times. 7 times. And that's why you just need to have a bit of patience. I trade maybe 2 to 5 times a month. That's it. If that, sometimes I trade once. It's just waiting for the opportune moment. And I know you're probably in a rush to trade and make money and make millions. You will make millions, but not in a rush, because when you're in a rush, all you're going to do is give money away to the markets. So just keep it simple. That's literally all I do. I just trade support and resistance on the daily and weekly time frames, and I jump on the 4-hour to look for a confirmation or a reaction in that zone, and then I just buy or sell, and I just walk away. I don't touch the trade. I don't look at it until I get a notification saying it's sold at, if it's hit the stop loss and it's sold, or if it's hit the take profit and it's sold, and that's it. I don't touch it. I leave it alone. And when you start doing that, you'll start to feel a lot more calmer inside, rather than watching every single tick on the 5-minute chart or the 1-minute chart, and you think, oh my God, it's all over, because, the 1-minute chart looks like it's fallen off a cliff. In reality, it's moved, 0.5%, but because there's so many candles, it looks a lot more intense than what it is. So that's why I don't go near it. And the levels aren't as strong, and they're not as reliable. So that's literally all I do. And I wrote literally, this is it. Price, my entry checklist before I enter literally is price at a key level on the daily and the weekly. Yes. 2, check market structure. Is price in an uptrend? Is price in a downtrend? Is price ranging? What way am I trading? Am I looking for long, shorts, or both? 4-hour confirmation. That's those rejection wicks, consolidation prices, holding that level, moving sideways. And then I just see, where can I enter that will give me the 2-to-1 risk to reward, where I can manage my risk, which is however much, 1 to 2, 5%, whatever it might be. Where do I need to enter so that I don't have to risk more? Because it's not about getting into every position. It's about managing your risk accordingly. So once all of those things align, I'll enter. If not, I'll just set a limit order where I can manage that risk, or I just let the trade go and I just wait for another one, and that's it. 1 to 5, 2 to 1 trades a month, whatever it might be, and I'll hold them for a day to a few weeks. It depends. It really depends. But really, in trading, simplicity equals consistency, and just react and don't predict the market. Just react to what it's telling you. And psychology is everything, because strategy is the easy part. Strategy is 10% of everything. The real battle is up here. And all the issues that you have with your strategy are all because of psychology. Because if you don't trust your strategy, it's not because the strategy doesn't work. It's a psychology issue, right? So just keep practicing at it and just keep it simple. Thank you for watching. I do appreciate it. I'll see you guys on the next one.